Today, folks, Canadian banks will always be Pokemon cards. You just got to collect them all. And we are heading into a Canadian bank earnings season where I'm still continually more bullish than ever, especially if you live in the United States right now. This is the most opportune moment in your life to take advantage of the most resilient financial companies on the planet, even better than your own, because these things survive much better during financial crises and are just way more stable. So like me and my fiance, we got to collect them all, and we do it through one simple ETF called VDY. And in this video, I want to break down just briefly why VDY is so resilient and it's my favorite Canadian investment. And then we're going to talk about the individual banks and what to look forward to and my bullish expectations, even on the back of, a tougher market environment where the economy is not going to grow like it was because the government's cutting immigration. We'll talk about interest rates, inflation, so much more. So if you are on a path to financial independence, if you damn well one day want to retire early, look no farther. Join me on that journey by hitting that subscribe, because VDY till I motherfreaking dies up 17.5 percentage points with a wicked, I think we locked in something like a 5% yield when I was buying this. Me and the wife went very aggressive. The wife and I, we sold all our individual Canadian bank stocks, or dividend stocks for the most part, because it just didn't make sense when VDY just gives you everything we love. So we don't have to figure it out, cost average, pick all these different stocks, because realistically, you only need like 20 or 30 Canadian stocks, and they're all upper weighted in this ETF. If you invested $10,000 back in October, or basically, 5 years ago exactly, right now you'd be up about 17,668. That is an incredible 5-year rate of return, total return, right? And if we just take a look a little bit deeper into this, and the reason I like it so much is that it takes the same system that the S&P 500's VOO takes advantage of, which is a market cap weighted ETF, which basically just means if the stock performs better by market cap, it takes a bigger weighting in this ETF. And I believe this is a truly genius systematic way of putting all your emotions aside and taking the best advantage of the best companies, whether you know about them, you don't, you think they're undervalued or overvalued. Same could be said with Nvidia and Tesla and all these companies that are rallying. You take advantage of those stocks even if you wouldn't own them in the S&P. But here we get Royal Bank and Toronto Dominion. In fact, I actually just downloaded their sheet of all the holdings just to show you guys, I really truly, when I am buying this, I am holding most of the Canadian stocks I talk about on this channel, which some people seem to disassociate, that when you buy an ETF, you don't actually hold the individual components, but you do. In fact, me and the wife, we've put over 100 grand in this ETF. So you got to presume 15,000 of that just went to Royal Bank, another 9,000 to Toronto Dominion, which, by the way, TD was a bigger weighting in this ETF until obviously it's gone through its issues and it's downsized a bit. It's almost more in line with Enbridge that's in here. But I'm going to tell you right now, 45% of this ETF just sits in the big banks. So literally almost half the money I put in this ETF is just going to the 5 big banks, right? Which is basically Royal Bank, TD. You can see Bank of Nova Scotia, Canadian Imperial's in here, Bank of Montreal. Then you scroll a little farther down, you're going to see National Bank there, along with all the other Canadian favorites. You got Manulife, you've got Fortis in here, you've got Bell, you've got TELUS, and all of these basically probably down to the Power Corporation are all stocks that sit above 1%. So these holdings here, probably about the 15 of them make up the vast majority of where your money's going. And these are stocks that, again, as mentioned, are 15 or 20 stocks I'd buy on my own. So I'm very happy. And I've also noticed things like Northland Power are in here, which is an original stock that I used to hold, one of the first stocks I ever bought a decade ago, which is incredible. You get great dividend growth from $1.48 to $1.94 over the last 5 years. This is like an annual dividend. If we actually just take a look at the dividend history, and we can break it down by monthly, because again, this is a monthly paying ETF. A decade ago, you'd be getting around 9 cents to 6 cents a month. Today, you're getting around 16 cents to 19 cents. So you've over doubled your dividend in a decade, right? So what more could you possibly ask for from the Canadian economy? Well, if you're a US investor right now, you've got the Canadian dollar on your side, which we're going to talk about in a moment, because basically, if you just look over the last 5 years from the peak to the trough here, you're talking about a 13% indifference. So, if you wanted to buy Canadian stocks right now, you're getting, a 13% advantage from the peak of the market. We're kind of back to where we were during the pandemic era. And if you're buying these stocks on that conversion, you're getting a crazy discount, because, one Canadian dollar equals 72 United States dollars. So, you're talking about almost a 30-cent difference here that you're able to put into some of these big banks that are still yielding incredible results, right? These stocks are growing up dramatically. You're getting huge yields. Royal Bank's up 27% year to date. TD's obviously the worst performer, which we're going to discuss why I'm still bullish on it. You got Bank of Nova Scotia just coming out of the the side blinders here, and I told you guys these were buying opportunities of a lifetime, and a lot of people took advantage. Some of you didn't. Again, I've been buying it through VDY along with my wife. We've owned the individual Canadian banks for years, and we will continue to. But look at this. I mean, it's up 23%. Again, it's when you buy, right? When the market absolutely cratered and these yields were at historic levels, that was the opportunity. Same with during the pandemic. These are rare opportunities. We've gotten them maybe 3 times in the last decade. So I hope some of you guys took advantage of it, right? BMO, another one of the flatliners. And again, why I find it so hard to just pick one. You really need to own them all because the cumulative comparable performance is what you're after with, Canadian Imperial up 34% year to date, National up 34.6, hitting all-time highs. You can get it all if you just want a sector-focused ETF in Canada. And you're like in the US, I would just buy Global X equal weight Canadian Bank Index. So this just takes all those big banks at the lowest possible fee, and you can see you'd be up 20% year to date. Plus, you'd have captured over 4% yield, which is just incredible. I mean, right now the current distribution is 4.18, which is still an incredible yield. And I think this ETF is only charging less than like a 0.09% fee or something like that, like a super low fee to maintain this. Because again, you're really just right here. So management fees 0.09%. It's almost non-existent, right? So yeah, this ETF's really, really cool and a very fun way to get exposure to these banks. And again, if you're in the US, take advantage of that conversion, because right now there's a lot of fear in the Canadian economy because the government has finally woken up to the immigration problems, which is going to hinder the growth of a lot of our companies, because when you have millions of people flooding in every year or so, I mean, that really adds to the amount of telecom use, to the housing use, to all this use. And now we're seeing interest rates get cut aggressively against the US rates that are still materially higher, which is why people are taking their Canadian dollars and putting them into US assets, fixed assets, high interest savings, treasuries, bonds, GICs, because that's where the money's being made. It's one of the reasons the supply and demand metrics are causing the Canadian dollar to drop, though we are getting a bit of a boost right now. I mean, the Canadian dollar did jump up slightly. I mean, we did see it actually in the last 5 days here jump up, a nice almost 1%. So it's nice seeing some momentum come back. Maybe this is US investors seeing Canada as, a very viable place of investments. But again, we're seeing our government take a massive shift that is going to impact some companies. It's impacting international schools right now. They're not allowing any more international students under certain, obligations and rules. So it's going to be very interesting to see what this means for the big banks. But I honestly think none of this really matters for them. There's one bull case that really bleeds into continued performance, in my opinion, and it's loan loss provisions. The only thing I've idly been sitting by waiting to see happen is when all of a sudden loans level off, and that'll probably happen sometime when interest rates get a bit lower, or even now we could start seeing it happening because we've seen a lot of renewals come up already. But what I'm talking about in the bullish nature behind this is if you take a look at provisions for credit losses on Royal Bank, they were materially going up until about the last quarter. The last quarter, they peaked at 920 million, and then they dropped down to 659 million, at which the stock started to rocket, right? Because we were able to actualize the record revenue. I mean, Royal Bank just recently acquired HSBC, which really boosted their revenue, which you can see on the quarterly here. I mean, the revenues really started to pop off from 38 billion to 42 on the 9-month ending is incredible. And they just haven't been able to actualize as much. I mean, you're talking about a company that has been putting just an absolutely, god-awful amount of money, 2.39 billion in loan loss provisions, which is up huge just from the year prior, and they continue to climb. But now that we're in the opposite direction, again, we should see these record revenues actualize into earnings here sooner or later. It's an inevitability unless the entire economy collapses, which hasn't happened yet. So I'm presuming it's probably not going to happen. Again, you can make your bets where you want, but these companies have survived the worst crises that financially has ever hit the market better than every other economy has. And they're going to probably continue to, right? Like, they're very resilient and they have more rules and regulations. They are monopolistic, but because they're monopolistic, they have higher regulation standards than perhaps a lot of companies and financial institutions in the US, which is why, during the interest rate cycle, you saw some banks in the US go under. That hasn't happened here in Canada just yet. But yeah, nonetheless, so Royal Bank's in probably the best position. They've already started the trend of, lower loan loss provisions, higher revenues, better earnings per share. You can see their earnings actually just came in, their net income in the 4.4 billion range, which was a record for them, which is great to see. If we take a look at TD, on the other hand, TD only had one bad thing going for them, and that was this money laundering scandal where they are going to get fined billions. They put a huge lump of capital aside for this. And we saw a one-time non-interest expense go toward this of 11 billion from 8.4 billion. This really hindered their earnings, but again, like Royal Bank, we're seeing record revenue growth. Absolutely incredible revenue growth. And this company is yet to be able to actualize and has been trading in the toilet because of this news. So my speculation is here, if we look at the, again, provisions for credit losses, they've already leveled off a bit. We're not seeing any explosive growth over last quarter. We should start seeing this do what Royal Bank's doing and perhaps level off or start coming down. And if we don't see this, no more of this, non-interest expense, these one-time expenses, we should actually see a material pop that might actually be worth, betting on this next earnings cycle, because the stock has materially not been able to perform at all. It's still down 27%, paying a great yield, potentially making it an incredible buying opportunity, in my opinion. So I'm very bullish on this bank for earnings. Now, when it comes to Scotiabank, this one's been on a tear recently. Just in the last, basically since they started cutting the rates, the stock's up 27%, and this is going to give you, a little bit more international exposure. Royal Bank's the purest Canadian focused sector for the financial institutions. TD has Canada and the US, and then Bank of Nova Scotia is giving you countries in the Caribbean. They have a lot more international exposure. And very similarly, I mean, you're talking about a company here that's generating 14.3 billion for the 9-month versus 13.5. We're talking about companies that still continue to grow record revenues, but this one got hit pretty hard with loan losses, still climbing for the business. So again, we need to see this turn around. We need to see it, and it is going to be life-changing for what these stocks can do when the earnings start to get actualized. Regardless of what happens now with the economy or immigration growth, we are still sitting in record revenue areas where we haven't actualized these revenues, and it's coming. It is coming. I have a very strong belief that it's not financial advice. It's my own intuition. It's my own influencer, clownish, bullish nature. So don't take this as financial advice. But again, I will just continue to aggressively buy VDY. I can get almost 50% exposure to the things that I absolutely love, and then some diversity into the other things that I would probably own in the Canadian economy. I really love this ETF. And then I get paid monthly to sit here and wait. But I pass that question off to you. I'd love to know what you're doing in that comment section below.